Good morning, all, and welcome to our third session of Tax Foundation University, where we are reviewing the various aspects of tax policy at the federal and today the global and international level to educate you about the various challenges and opportunities that come with reforming and improving our tax code. Very special session today as we have a guest with us, our Vice President of Global Projects, Daniel Bunn, who will be walking us through the various aspects of the international side of the federal tax system, as well as a lot of the more interesting debates happening on that side of tax policy today. Before we get to that, we will also be covering how the corporate income tax system works, the various components of it, items that you should be aware of in these debates, common misunderstandings, and much more. So excited to dive into this. And as usual, if you have questions as we're going through this material, feel free to put those questions in the Q&A feature of Zoom. We'll make sure to get to those as soon as possible. We'll make sure to leave some time at the end for those questions, especially because some of this content can be challenging to wrap your mind around when you're first getting to it. So we'll make sure to walk you through it every step of the way as we continue our examination of the tax code. And so to get started, we're going to walk through the basics of the corporate income tax. My colleague Erica, an economist here at our federal team, will be covering that. I'll be covering some of the implications as it relates to the domestic side of corporate tax policy, some of the more important elements to think about in some of these debates, especially now with a lot of the proposals that are floating around. And then our colleague Daniel Bunn will be covering international tax policy, the ways to think about it, the many different ways in which international income can be taxed, as well as how that fits into the larger debates today. So to get started, as we have a lot of ground to cover here in the next 45 minutes, I want to turn over to my colleague Erica, who will be talking about how the corporate income tax works in the US and contextualizing it in our federal tax system.
Thanks, Garrett. So we can switch to the first slide. There we go. So we'll start with just looking at the corporate income tax rate in the United States, where it sits now, how that compares to where it's sat in the past, and to other nations. So currently the federal corporate income tax rate is 21%. That's down from 35% where it was prior to the 2017 Tax Cuts and Jobs Act. But an important element to think about when we're thinking about the corporate tax rate is that most states in the US also levy a corporate income tax rate. So corporations face both the federal and another layer at the state, resulting in a combined rate that's higher than the 21% federal rate. So if we look at the average of state corporate income tax rates, corporations in the US face an average rate of 25.7%. That puts us right about in line with the average among OECD member nations. So there's sometimes a perception that when the rate was lowered to 21%, that made us an outlier and having a really low rate. But you have to factor in those state level taxes when you're looking at the international comparisons. And by doing that, you can see, it's a little hard to see on the slide here maybe, but the orange line is where we were at right after tax reform, so close to the middle. The red line at the top is where we were prior to tax reform, so we were an outlier then, having the highest rate among OECD nations. That rate combined prior to TCJA was 38.9%, about 15 percentage points higher than the OECD average. So as we sit now, we're right about in the middle of the pack, and that's important context to keep in mind as we think about proposals to increase the rate and where that would take us in these international comparisons. So we can go to the next slide. So that was the rate. Now we can think about the corporate income tax base, or what activity is being taxed at that 21% rate, and then the state rate as well. So the corporate tax base is, again, like we saw last week with the individual income tax base, a sort of hybrid between an income-based tax and a consumption-based tax. In many ways, our corporate income tax base aligns with a corporation's cash flow, as it defines taxable income as revenue less expenses. However, there are some types of expenses that can't be fully deducted, which gets us closer to an income tax base. So some of the major expenses that receive deductions when thinking about the corporate income tax are the cost of goods sold, interest expenses, depreciation and amortization for capital expenditures, and other forms of taxes besides the federal income tax. So we can go next slide again. So here's like a very simplified version of how business income taxes in the United States work. Your first step is to add up your revenues to get to your total income or your gross income. Next, you would subtract your expenses or take deductions. So things like wages and salaries for workers would be deducted. Cost of goods sold would get immediate deductions. Interest expenses are currently limited, so those cannot be deducted fully. A limitation to those was introduced in the 2017 Tax Cuts and Jobs Act. And then there are other categories of expenses that also can't be immediately deducted. Most importantly, when we're thinking about that, is that businesses don't take an immediate deduction for their capital expenditures. That can be things like that would be used for a long time. So things like machinery, furniture, computers, buildings, and so on. Instead, businesses are required to deduct the cost of their capital expenses over a longer period of time according to set depreciation schedules. So for instance, if a timber company was going to buy a new chainsaw, they would generally be required to deduct that over 5 years. Or if a railroad company bought a new bridge, they would generally deduct that over 20 years. There's a system called the Modified Accelerated Cost Recovery System that has schedules of these amortization and depreciation deductions that are allowed. But I will note that under current law for assets that under that schedule would have a useful life of 20 years or less, they do have a temporary provision that allows a 100% write-off. So again, you see the hybrid of our current system that allows full deductions for some things and not full deductions for other things. So those are known as depreciation deductions. They are one of the deductions that you subtract from revenue to get to your net income. And so next you can offset your net income with past losses. Net operating loss deductions are a really important feature of the tax code. And that's because some businesses, their profitability can vary over time. You can think of things like new businesses or those that operate in cyclical industries. They may suffer from losses. So NOLs can help smooth out tax liability over time and prevent the tax system from punishing companies that have these uneven earnings patterns. So NOLs allow businesses to be taxed on their average profitability, which helps make the tax code more neutral. There are some limitations on NOLs under current law. One of the things that had to be addressed in the coronavirus response and the CARES Act was loosening some of those limitations to help companies have access to their NOLs and smooth out their cash flow. So NOLs are an important component of the corporate tax system. So once you take care of loss carryforwards, you arrive at your taxable income. That's when you apply the 21% corporate tax rate to calculate your tax, and then you can offset that with tax credits similar to what we see in the individual income tax code. So the four largest tax credits by size that corporations take are the research credit, the low income housing tax credit, the energy credit, which can be on top of the research credit, and then a renewable electricity production credit. Those are the largest tax credits by dollar amount. We can go to the next slide. So those tax credits and other things in the corporate income tax base are considered corporate tax expenditures. As we saw last week on the individual side, that's where the majority of tax expenditures are. Corporate share of tax expenditures is just about 10%. So in 2020, corporate tax expenditures totaled about $170 billion. And again, we get into this sort of distinction between which tax expenditures are important structural elements of the tax code or important changes to the tax base to prevent a bias against a certain activity versus which expenditures are preferential. And that depends on what the definition of the normal tax code is. Is it an income tax or a consumption tax? Largely, these the Joint Committee on Taxation uses a sort of income tax definition. So something like the accelerated depreciation or bonus depreciation, that 100% write-off for short-lived investments would count as an expenditure because it's a faster write-off than what would be allowed under an income tax. So that thinking or that framework says that when a business spends $1,000 on a jackhammer or a chainsaw, its net worth didn't decrease. It simply transferred its wealth from being held in cash to being held in this asset. So the business shouldn't be allowed to immediately deduct the $1,000 it spent on that jackhammer. But under the income tax framework, that jackhammer will decline in value over time, or it will depreciate or wear and tear. And so the business should get to take a small deduction to account for that wear and tear over time. Allowing the full $1,000 in year one would exceed the wear and tear in year one. So it's counted as a tax expenditure under the definition of an income tax. But from the consumption tax point of view, when the business spent the $1,000 on the jackhammer, it expended $1,000 in cash. So it should be allowed to take the $1,000 deduction immediately. Revenue less your expenses is your income. So if we defined normal as a consumption tax, accelerated depreciation would not count as a tax expenditure. We can go to the next slide. So the largest expenditures on the corporate side, just for scale, you can see there is about $45 billion in 2020, much smaller than the expenditures on the individual side, which makes sense given the share that the corporate only makes up about 10% of the expenditures in the tax code. Some of the largest expenditures are accelerated depreciation. And again, as we just explained, that's just because of the definition of normal tax code that's used when determining expenditures. We would think that something like accelerated depreciation is an important structural element of the tax code. It helps correct for the inherent biases that would be in the income tax system or in the normal tax base without that expenditure. There are other corporate expenditures, though, that do represent distortionary preferences. Things like specific tax credits for energy production that come on top of the general research and development tax credit. There are green energy tax credits, regular energy tax credits, or more traditional sources of energy. Things like that are preferences for specific activities. And so those do represent a sort of deviation from the normal tax code, providing a benefit above and beyond what would just be conferred in the regular tax system. There are also things known as negative tax expenditures. So a negative tax expenditure is the opposite. It's something that raises revenue or provides less favorable treatment than would be conferred under a normal income tax system. And it's something that's not directly related to trying to increase the progressivity of the code too. So things like the net interest deduction limitation that the 2017 tax law introduced count as a negative tax expenditure. Limitations on other deductions similarly count as negative tax expenditures. So big picture takeaway, when you're thinking about corporate tax expenditures and individual too, not all of them are created equally. Some are truly distortionary things and would probably be worthy of elimination, or at least a second thought in their design, while others are really there to ensure that the tax base is properly structured. And with that, I'll hand it over to Garrett to talk about some more implications of the corporate tax rate and the corporate tax base.
Thanks, Erica. So there are a few different implications to the domestic side of corporate tax policy as it relates to both the rate and the base. And Erica, I think, set this up well in thinking about how different changes to specifically the rate might affect behavior on the part of corporations. One big thing that it can actually be a little counterintuitive, but it's an important effect, is a lot of folks, when they think about changes to the rate, think about that rate in the context of its effects on net income, right? If a corporation, in a very straightforward example, has say $100 million in net income and you raise the rate, say from 21% to 25%, that is of course going to reduce the after-tax return to any given investment, right? And that may, in our modeling and the modeling of many other organizations who work in tax policy, that's going to reduce the amount of investments that will have viability in after-tax terms, because those returns are falling overall, and certain investments that previously looked viable or were on the margin, meaning they exactly broke even, no longer are viable when that rate goes up. But there actually is a countervailing or opposite reaction when it comes to the value of deductions. And that's because deductions are more valuable when the rate goes up. So it's important to keep that in mind, because that will have an effect on incentives that certain corporations have depending on the nature of their work and the value of their deductions. To take a very straightforward example, if you saw a rate go up, say from 25% to 30%, you would have, for any given deduction, a deduction will actually be more valuable when you can deduct it at a 30% rate than at a 25% rate. And so that's important, especially when you think about various tax assets that may be on the books of corporations that they are carrying forward into the future. They may decide to, for example, implement those assets when that rate is higher because those deductions are going to be more valuable. They may time their investments in a way to maximize the value of those deductions as well with those rate changes. This is especially important when thinking about phase-ins with tax policy. Something that's been floated recently in the context of corporate tax reform, because corporations and other firms are going to try to be strategic about the deductions that they might be taking with respect to the rate to help offset some of that effect of a higher rate on net income and the resulting reduced after-tax return. So that is an important effect. It's very rarely an effect that dominates the decisions of corporations long-term. That after-tax rate of return is still really the guiding star for thinking about overall investment. But this other effect as it relates to tax deductions is important when you're thinking about the timing of investment behavior and thinking about what types of investments warrant certain deductions that might be more valuable depending on what that rate is. I think I got into this a little bit here, but of course the investment incentive on the margin is going to be reduced if the rate goes up because of that lower after-tax rate of return. It's also important to remember that corporate rate changes affect two different things when it comes to investment. They affect the existing investments that have already happened that are generating returns and that are going to be subject to that new rate. They also impact new investment on the margin. So you can separate those two things out, right? Where in the extreme case, which is very unlikely to happen, you could implement a new rate only on existing or previous investment. And because that investment has already been done, there's not a lot of behavioral change that can be done to avoid that type of tax, right? Likewise, when the rate goes down, you may have some benefit to having a higher after-tax rate of return for investment decisions you've made in the past. The challenge, though, is that because we raise the rate and it affects both existing investment and new investment, you are going to harm investment incentives moving forward, because when you're looking forward into the future, you're thinking about what that after-tax rate of return is going to be, and whether or not, when you have to pay out your taxes, your depreciation, the various other costs of investment, is it actually worth it to move forward with that investment? And that's really important, especially in the context of the base, which I'm going to talk about as well. So as Erica just mentioned, a really important part of calculating what we economists in wonky jargon call the cost of capital, or effectively the cost of making an investment and then the resulting after-tax return you're getting from that investment, is how much a company can actually deduct for the various costs of an investment. Under current law, a lot of related costs associated with running a corporation or even other firms and other forms of business for that matter, is immediately deductible and fully deductible. When you think about, for example, worker wages, for the most part, in many contexts, those costs are fully deductible. When you think about the cost of goods sold, which often are including wages and other costs contained to various goods, those things can be immediately deducted. But the tax code, even under the Tax Cuts and Jobs Act, which made some progress here, not all investments can be fully and immediately deducted. And as Erica outlined really clearly, that can have an economic cost because you're not fully providing that immediate deduction when that investment is being made. And so there's an asymmetry there between allowing a full and immediate deduction for all the other associated costs that firms are incurring when making investments, and the type of deductions you can take for making investments into tangible items like machinery and equipment, or even longer lived assets such as structures. Under current law, you can fully and immediately deduct the cost of short-lived assets in what is known as bonus depreciation up to 100%, though structures under current law are still subject to a depreciation regime where you must depreciate the value of that structure over several decades, depending on whether or not it's a residential or a non-residential structure, up to almost 40 years in the case of certain structures. And the reason why this is important, another way to think about this, is when you do not provide an immediate and full deduction for the cost of investment, you're effectively requiring a firm to pay tax on that investment for returns that actually haven't materialized, right? And a really simple way to think about that is because you cannot immediately deduct that full cost of that investment, that means you have a higher taxable income than you otherwise would have, right? If you had a taxable income of $100 and you had an investment of $100, a full deduction for that would yield a taxable income in this period of 0. If you can only depreciate it over, say, 10 years, and you can deduct, say, a straight line amount of $10, that means you have a $90 taxable income that's going to be subject to tax. So that's another way of thinking about it. And the difference between, of course, that depreciated amount and the total tax you'll pay over the very long run is the cost of waiting for that deduction. You wouldn't eventually get that deduction over the course of, say, 10 years, but there are two factors that you're not capturing when you provide for that. One, of course, is inflation. That's going to be a very, very real cost. And the second, of course, is there's a very real cost to waiting that is known by economists as the time value of money. And that can be a problem because otherwise you could take that money and invest it elsewhere and yield a rate of return. And that's an opportunity cost that's been given up when you don't provide that immediate and full deduction for investment. And so that's a really important structural part of the code. And the other thing as it relates to what I mentioned about the rate is the shift toward providing that immediate deduction for those costs only incentivizes new investment. It's not providing a windfall or a benefit to existing investment because it's only moving forward. On the margin are you getting that immediate expensing and full immediate deduction. Finally, I wanted to make a note about the tax treatment of inventories and interest, which can be tricky parts of the tax code. Starting with interest, as Erica mentioned, under current law, there are limitations to how much interest a firm can deduct on their end of things. And the important thing to think about in the tax treatment of interest, which may come up a bit in the more application side of things in the next two sessions, is you both have to think about the taxation of interests as it is being paid and the taxation of interest as it's being received, right? Because theoretically, you could provide a full deduction for interest as it's being paid and then fully tax it when it's being received. Or you can do the opposite, right? You could fully ensure that there is no deduction for interest as it's being paid, but then also ensure that there's full taxation when it's being received, or vice versa. You can provide that immediate deduction and then ensure that it's tax exempt when it's being received. And so an important part about thinking about the taxation of interest is when you either have it not being taxed on one side or the other, or it's being double taxed, that can create disincentives for various forms of financing, including debt financing, that have interest associated with it. And finally, with inventories, often inventories as it relates to the corporate tax have a separate, very complicated set of rules about how you can deduct the cost of inventories because you are investing into them and they might be sitting for a long period of time before they're being sold or used. And they can only be deducted for the purposes of tax when they're actually being sold off. And so there are three very big picture regimes that you could think about when you're thinking about the tax treatment here. And it all comes down to timing of which inventories you're taxing first, particularly as it relates to inventories of goods that are identical, right? When you think about a barrel of oil, if you have 100 barrels of this oil, you may have received the first barrel 6 months ago, and you have the 100th barrel now. The question is, if you sell one of those barrels of oil, which barrel, if they're identical, should you have to account for for tax purposes, because the barrel a year ago when you got it may be a very different basis. It might be a lot cheaper or a lot more expensive than the barrel you have now. And so there are two ways in which this can be done. Very briefly, you could do a system where the first barrel that comes in is the first barrel that you can deduct when you sell one. That's known as first in, first out, or FIFO. The alternative would be the last barrel you get in, you can deduct when it is sold. That is known as last in, first out, or LIFO. There are trade-offs related to either one. A third option, of course, is you can sort of average these things together and create an average cost of your inventory over time. The big trend, bottom line on this, is usually inventories that have been created and then first are lower in cost than inventories that have been created more recently. Not always true, but typically that can be true. Meaning, if you implement a last in, first out regime, or known as LIFO, you are providing a little more tax benefit for the purposes of inventory and deducting that inventory than you would under a first in, first out regime, or even an average regime. Lots of trade-offs related to that and complicated nuances, but that is the big picture trade-off as it relates to the tax treatment of inventories and what your tax bill will be when you deduct those inventories. So some of those implications out of the way, I want to make sure we had time to turn it over to our colleague Daniel, who's going to provide us some really informative overview of how the international tax system works with respect to the US tax system and the various debates that are happening in that space today.
Thanks, Garrett. I'm glad to join this morning. You've been hearing from Garrett and Erica for a while. Just a little bit about my role at Tax Foundation. I run our global programs. So most of the time I'm looking at tax policies in other countries, but also a portion of my job is looking at how US tax rules impact other jurisdictions or US multinationals or foreign multinationals operating in the US. And I think it's important to start with kind of a concept of what a multinational is, the importance of multinationals kind of in the global economy in the US. US multinationals had around 30 million employees in the US in 2018. So a really big employment footprint, much larger economic footprint. And there's also inbound foreign multinationals that have a lot of operations in the US. I grew up in Greenville, South Carolina, and the names around the block, a lot of my friends and had parents or other friends who worked for these companies like Michelin, BMW. So multinationals have a big footprint in the US economy, and the tax implications of some of the things that I'm going to talk about today will have some effects on the way those companies do business, where they hire, where they invest, and so on. So international tax policy is really about how countries decide when their corporations are taxed, where they are taxed, what activities they are taxed on. There's a lot of different ways that countries attack this issue. And right now there's ongoing discussions at the international level about how countries could potentially move together to change some of these rules to have a little bit more, harmonization at the international level. So think of a US company that has a operation within the US producing widgets and sells them to a firm in the United Kingdom. So if it's purely exporting, if it's just building these things in the United States and selling them to another customer in the UK, a separate entity, there's implications for international tax on that. We have something called foreign-derived intangible income. So if the US company is using intellectual property that's based in the US to create and export those items to the UK, there's some international tax rule implications for that. Separately, the US company could be exporting not to a separate entity in the UK, but a subsidiary in the UK. And that subsidiary in the UK could then sell those US made products to customers in the UK or in Europe. There are separate implications for taxing that company in that respect. We have something called global intangible low tax income. So if the profits of the US subsidiary in the UK are above a 10% return to tangible assets in that foreign subsidiary, then the US might tax those foreign earnings of the US company. And it's important, this third point on this slide, that the US tax rules treat individuals and companies differently. The US has pretty close to a pure worldwide system, and we'll get into what that means in a minute, but a pure worldwide system for individuals. So wherever you are in the world as a US citizen, it's likely that you will owe some tax, or at least have to file taxes with the IRS. If you're a corporation, it really depends on the situation. The US may ignore some foreign income. In some circumstances, the US may tax some foreign income in other respects. And again, for inbound companies, foreign companies that are operating in the US, different rules apply. Garrett, can you advance the slide here? All right, so there's three big kind of picture terms for corporate taxation in the international scene. So some countries have, well, it's best to talk about these things theoretically before we get into the country. So one approach would be a worldwide approach, where you have companies within your country that do have operations, have income all around the world, and the US or another country taxes that income regardless of where it's derived, whether it's a US company doing business in the UK or doing business in Brazil or wherever. Some of that income might be taxed by the United States. That company would have to file a tax return connected to that foreign income and pay tax to the IRS. Then there is source-based taxation, and this looks at kind of where the activity actually happens, and where the activity happens, that's where the taxes are owed. So if you have this US company with a foreign subsidiary in the UK, the US taxes the profits from the activities within the US, and the UK taxes the profits from the activity within the UK. And there's this kind of border, the reason it's called territorial or source-based is where the source is, and the territory where that source is the one that has the right to tax. And then there's a third approach, which is the destination-based approach, which is thinking about where the customers are. So back to the example of the US company with a foreign subsidiary in the UK, and that foreign subsidiary in the UK is selling to customers in Europe. Let's say it has customers in France and Germany. The destination-based system says the profits connected to the sales of these different widgets would be taxed where the customer is located, in Germany or France, rather than the source or a worldwide approach. And it's important to think that these might be somewhat clean theoretical concepts, residence-based, source-based, or destination-based. But Garrett can go to the next slide, and I'll talk about how these kind of mix and match in some respects. So even the US system, we have both residence treatment, where we tax companies to some extent on their worldwide income. I mentioned global intangible low tax income, GILTI. The global in that is essentially saying we want to tax some share of corporate income within certain rules, regardless of where it's created around the world. But then there's also this source-based approach. The US in the Tax Cuts and Jobs Act adopted some territorial provisions that said in some circumstances, if a US company has foreign earnings, those foreign earnings aren't going to be taxed by the IRS. Those foreign earnings can come back into the US without an extra layer of tax. And this is very different from our previous system, which was pretty close to a pure worldwide system, albeit a deferral system, which said if a US company had foreign earnings, it wouldn't have to pay tax on those foreign earnings until those came back to the US parent company or a US shareholder for those earnings. Now, the US doesn't really have any destination features in our tax system right now. Some of you may recall that in 2016, there was a lot of discussion about a destination-based cash flow tax, but instead of going that direction, we ended up with this kind of hybrid system. And other countries have these kind of hybrid rules as well. There's most countries around the world have a mainly source-based taxation system, a territorial system, like the US now has some features of. But they also have some rules that say if you have foreign earnings, in certain circumstances, we're going to tax those foreign earnings. Now, why would you want to do that? One main reason is that low tax jurisdictions exist, and companies can use low tax jurisdictions to avoid domestic tax or to flow their foreign earnings into a low tax jurisdiction and minimize their foreign tax. So a lot of countries, including the US, and in fact, the US is a bit of an outlier on this with the strength of its rules, but they have these anti-base erosion rules that essentially treat foreign income in some global treatment and require domestic tax paid on foreign income, even though most of their tax treatment is on a territorial basis, thinking about where the production actually happens and being taxed there, as opposed to saying, you know, we're in the US, we're going to tax this foreign earnings, even though it's not within our jurisdiction. You can go to the next slide, Garrett. So, like I said, these taxes systems fall kind of between residence and source. And again, most developed countries are closer to source-based or territorial taxation of corporations rather than worldwide. It used to be the case that a lot of countries had worldwide tax systems, but in recent decades, and the US is the most recent example of this, a lot of countries have abandoned worldwide treatment and moved to a source treatment. Now, there are examples of countries pursuing destination-based taxation. A lot of countries in Europe, some countries in Southeast Asia are pursuing digital services taxes, or they've already adopted these. And these have a destination-based element to them where the countries say digital companies, even though they're, you know, a lot of them are in the US or in other countries, they have users within our country. So France says, you know, we have a lot of users of these digital companies, and the users create data, or their data is used by those companies to create value, create new products and things like that. And they're using a sort of destination-based approach to saying those foreign companies need to pay tax in France based on the presence of these end users. And it's not a great approach the way they're actually implementing this. They're not doing this based on net income. It's a gross revenue measure that they're taxing with these digital services taxes. And the US Trade Representative would tell you that they are discriminatory against US companies. Another approach for destination-based taxation, which hasn't really been implemented, but it's had a lot of conversation recently, is sales-based formulary apportionment, which essentially says you've got a multinational with sales all over the world, then countries are going to split up the taxable income of that company based on where its sales are. So if you're a US company, maybe you have most of your sales in the US, but you also have maybe 20 or 30% of your sales elsewhere. So instead of taxing all the profits of that US company within the US because of, you know, source-based principles, it would say, no, we're only going to tax the profits connected with the share of sales in the US. Now, it's challenging to get countries to agree to evenly split up the pie. There's challenges of potentially double taxation and coordination and how you define the tax base and the tax rate, but this is part of the conversation. The OECD proposal on Pillar 1, which I believe we'll talk a little bit more about in a future session, but it has a destination-based principle as well, where some share, a slice of corporate profits might be taxed in jurisdictions where sales occur. Garrett can go to the next slide. So I've already mentioned a few of these things, but the Tax Cuts and Jobs Act really changed the US system from a number of ways on this front. The international tax rules have gotten a lot of attention in recent days. And I think it's important to understand where the tax system was prior to Tax Cuts and Jobs Act and where it is now, before thinking through like what you might want to change with that tax system. So prior to the Tax Cuts and Jobs Act, as I mentioned previously, the US had a worldwide tax system with deferral. Again, that meant a US company with foreign earnings would have to pay tax on those foreign earnings if those foreign earnings were brought back to a US shareholder. So if you've got the US company with a foreign subsidiary in the UK, the US company makes the widgets, sells the widgets to the UK. The UK does something with the widgets, improves them, gets them ready for customers, and then makes profit. The foreign subsidiary makes profits actually getting those widgets to users. Those profits in the UK foreign subsidiary, they might be valuable for the US company to redeploy in manufacturing and hiring to make more widgets in the US to do, the whole game again, but with, maybe a bigger and better product. However, under previous rules, the UK would tax those profits, and then the US would tax those profits upon repatriation. So if the UK company created a dividend to send back to the US parent company, the US tax rate of 35% or 38.9, as Erica was talking about, combined federal and state rate, would apply to that income. It essentially built walls around our tax system. They're basically barriers to bringing foreign profits back home for redeployment. So the Tax Cuts and Jobs Act changed that. They said now those foreign dividends can come back to the US with some exceptions, tax-free. Companies can redeploy those earnings however they want. They can redeploy them in the US, they can redeploy them abroad, but we don't want to have foreign earnings held offshore artificially just because of our tax rules. Now, again, because low tax jurisdictions exist and because opportunities for avoidance exist all throughout the tax code, not just in the corporate sector or the multinational sector, there were some anti-base erosion provisions put in place. So the participation exemption is this exemption for foreign earnings to come back to the US without tax. But then GILTI, Global Intangible Low Tax Income, says if you have foreign earnings that are greater than a 10% return on foreign tangible assets, let's say machinery or a research facility in a foreign jurisdiction, or a distribution facility in a foreign jurisdiction, if you have profits above a 10% return, you might get caught by GILTI. Now, GILTI is an extra layer on foreign taxes. So depending on how much foreign taxes you're paying on your foreign earnings, GILTI might bite harder or not as much. And there's a foreign tax credit that offsets some, but not all of those foreign taxes paid on those foreign earnings. So GILTI kind of sits on top of the foreign taxes that companies pay on those foreign earnings. But then you have something called FDII, Foreign Derived Intangible Income. And GILTI and FDII were meant to kind of balance incentives for companies that were thinking of either offshoring IP or software or things like that to lower tax jurisdictions. GILTI says you're going to pay tax on that IP at least a rate of 10.5%, very likely much more than that, probably 13.125 or above, or you're going to pay 13.125 on having that IP in the US and exporting from the US. So GILTI sets the rate on the foreign earnings related to intangible assets, and FDII sets the rate on earnings related to intangible assets if you're doing the production in the US and exporting from there. Now, both GILTI and FDII have intangible in the name, and GILTI has low tax in the name. That is helpful to say that's the general intent of these rules, but they have different implications depending on what industry you're in. So GILTI, even if you don't have intangible assets that are creating these large returns, you might be caught with GILTI. I've looked at some data that shows manufacturing industry is pretty highly exposed. Now, there's certainly some IP behind some of the profits in the manufacturing sector, but you think of often heavy manufacturing, lots of plants and equipment, lots of tangible assets, and there's still potential for GILTI liability. Same thing with FDII. There's potential for a lot of manufacturing and heavy industry in the US connected to some intangible asset that would create an advantage for those companies. And again, these are meant to balance the question of, I've created this new software or this new intangible assets. Where am I going to put it in the world? And GILTI and FDII paired together we're supposed to say, hey, you might as well keep that in the US. There's not going to be a great advantage for putting that offshore. Then we get to the base erosion and anti-abuse tax, the BEAT. The base erosion and anti-abuse tax is essentially a minimum tax. Well, GILTI kind of works like a minimum tax too. So Tax Cuts and Jobs Act brought in 2 minimum taxes to minimize the tax advantage that some companies might get through cross-border transactions, where you have a deductible payment in the US and income in a foreign jurisdiction that might be lower tax rate than the US. And the base erosion and anti-abuse tax kind of clamps down on some of that cross-border activity. It's a lot broader than, the impact has been much broader than probably intended. But all of these things come together to really get a hybrid system, territorial, worldwide, and to some extent, some destination features all mixed together. In a lot of ways, it's pretty complicated. Things were complicated before tax reform. They're still complicated even now. Garrett, can you move on? All right, so Garrett's already talked about the implications for corporate tax policy with respect to domestic companies. For foreign profits, there's several implications. Because multinationals are multinational companies, you could potentially have your headquarters anywhere. There's important tax implications for where a company has its headquarters. Are U.S. companies going to be taken over by a foreign multinational for tax purposes? Are U.S. companies going to say, hey, we're just going to change our address to Ireland or to some other jurisdiction for tax purposes? If there's a huge tax differential, which we'll get into in a moment, there's more of an incentive for a company to say, we are resident for worldwide tax purposes, for purposes of GILTI or purposes of other countries' taxes on foreign earnings. We want to take advantage of the way another country treats foreign earnings rather than the way the US treats foreign earnings, or want to take advantage of the way a foreign country treats its resident companies or its source-based rules relative to where the US treats those rules. So that's where you get into this cross-border investment. So if you have an investment and you're thinking about the after-tax profitability of a plant or machinery or R&D lab, you're going to look around the world and say, okay, well, where is the talent market for that? Where is something close to my customers or close to other research labs, or maybe there's a hub for doing the type of research and development that you're looking for? But also look at the tax implications. If you're able to do, meet all three, have a talent market, have the local kind of investment or research hub that you can be connected to, and have good tax treatment, then you might want to invest more in those, foreign tax jurisdictions that might have a lower tax profile than the US. But because we have a minimum tax in GILTI, that'll claw back some of the effects of saying a company would just, focus on only low tax jurisdictions. But it also has an implication on profit shifting, the ability of companies to simply recategorize or through accounting mechanisms say where their profits are. So in theory, a company could, this is somewhat close to reality as well, company could say that most of their profits come from a sales office in a zero tax jurisdiction or a low tax jurisdiction. Zero tax jurisdiction, maybe think of the Cayman Islands. Low tax jurisdiction, maybe think of Hungary with a 9% corporate tax rate, or Ireland with a 12.5% corporate tax rate. And if you're able to arrange your corporate structure so that the profits show up in those low tax jurisdictions, then maybe you could avoid tax. But that's the purpose of GILTI, where it comes in and says, no, we're going to make sure that those companies that even if they are paying low rates of tax elsewhere, there is still some tax paid to the United States. The US rules don't really get in the way to a lot of extent to cross-border investment decisions, other than to make sure that US companies are paying some rate of tax to the US. Now, you could imagine a scenario where the burden on foreign earnings is such that it doesn't really make sense to be a multinational anymore. You could have such a high burden on foreign earnings that US companies would just say, hey, we're going to contract with foreign entities. We're going to be a purely domestic US company. with exports to foreign entities that we're not going to own or control, and essentially throw sand in the gears of the global cross-border investment and trade trade market. So those are some of the things to think about. You can, have reasonable rules to combat profit shifting that allow for continued cross-border investment. But if you tighten the screws too much, then you're going to have not only, potentially no profit shifting, which might be a good thing, but also you might have less cross-border investment, and that can have blowback effects on those U.S. workers that I mentioned at the beginning. Again, 30 million U.S. workers work for U.S. multinationals. And that's a pretty big footprint in the US. So if you think of policies that would decrease the efficiency of these companies to be able to work across borders in a global market setting, then that can impact local investment and hiring behavior. Garrett, can you go to the next slide? So one thing on the profit shifting metric is that it's the rate differential that matters. There's a lot of academic research that looks into this. And if you have a high local rate and a low foreign rate, you're going to be a company that really wants to shift its profits to lower jurisdictions. And this is certainly what we saw prior to Tax Cuts and Jobs Act. The US had a very high rate of 35%, 38.9, as Erica mentioned, including state. And that was an outlier on the world scale. The US companies had an incentive to say that they were reporting profits in foreign low tax jurisdictions, and an incentive to keep those profits outside the US. And the company can save essentially that tax differential simply by shifting activity or shifting profits in an artificial sense to a foreign company. And the corporate rate also impacts where a company locates its investment. Again, you've got a company maybe that's thinking about building a new R&D facility. Will it build it in the US? We have a pretty great labor market. We have pretty great treatment for R&D, but is there better treatment elsewhere? The corporate rate can matter for that location of investment decisions. Same thing with inbound companies. Foreign companies can, say they can serve the US market from Mexico, they could serve the US market from Canada, or they could serve the US market by locating investment here. And the corporate rate impacts both the total return on that investment on an asset basis and the return on new investments. So this isn't just saying that these are new factories, but existing factories or existing productivity or existing research and development facilities that would be impacted by the rate differential. So with that, I think that wraps up my slides. There may be one more there. Nope, that wraps it up. All right. And I think we're going to go to questions now.
That's right. Thanks, Daniel, for that very helpful presentation. I think one of the big questions that came up here, what is the risk of Treasury Secretary Yellen's proposal for a global minimum tax rate from 21% all the way up to 28%? Is that proposal viable? I think, Daniel, you may have some perspectives on this.
Sure. There's two pieces to the viability. Number one, is it viable from an economic sense? Does it make sense for the U.S. economy, for the U.S. to have tax policy that says we're going to have a 21% tax on the earnings of U.S. companies wherever they have their profits? I think that would be a significant impediment to cross-border investment, to the competitiveness of U.S. companies. This gets pretty close to what I was talking about as far as whether it would make sense for a U.S. multinational to be a multinational. You may have more companies simply contracting with third parties in different jurisdictions simply to minimize their exposure to these taxes on foreign earnings, so that all their earnings are just domestic earnings and they just export from there and lose some of the efficiency that you get out of being a multinational. And same thing with inbound companies. Does it make sense for the U.S. to be part of a foreign company's supply chain? Does it make sense? Certainly, you could have a significant market exposure by being part of, having customers in the U.S. But would it make sense to supply those customers through Canada, Mexico, or some other jurisdiction where you're simply exporting to those U.S. customers? So the viability on the economic front is one thing, but the viability at the global level is another thing. There's a whole discussion right now about whether countries would agree to a high minimum rate. And I think there's always going to be a chance with a global agreement that you're going to get some level of instability. You may be able to get a lot of countries to agree, hey, this is what we're going for. We're going to put this into policy. But then a couple of years down the line, countries are like, no, I want a 15% minimum rate. I want to, kind of undercut this agreement in one way or another. And I think it's important to think of how you're balancing what your goals are, which may be to have some higher level of tax on foreign earnings of U.S. companies, with whether other countries are simply going to undercut you and make it less competitive to be a U.S. multinational, or to have the U.S. part of your corporate footprint. I think this will be critical for maybe the next 20 or 30 years, what decision is made on this global minimum tax.
Thanks, Daniel. We have a few more minutes for questions if folks want to use the Q&A function. Very quickly, I also wanted to mention we've heard that it can be helpful with a lot of the information that we've provided in this presentation to sort of sum up 2 or 3 main takeaways, and a couple things I just wanted to highlight, and I'm sure Daniel and Erica can jump in if you have others. One bottom line thing is that the structure of the corporate tax really matters. Cost recovery and is especially important when thinking about investment incentives. It's not just about the rate, the base has to be designed well. That's also important because you get back to that basic principle of sound tax policy of broadening the tax base properly to ensure you're taxing net income while also lowering that rate, which can provide a stable source of revenue for government services at a more efficient way. And then the other thing, which I think we'll get into a little more in the next couple of sessions, is that I just want to make sure to highlight here in the context of the corporate tax is we've generally found in our modeling that it is one of the more damaging forms of taxation on economic growth. That's echoed in a lot of the research that's been done by the OECD as well, especially because capital is so mobile. We generally find that the corporate tax does the most damage per dollar raised because of the way in which it in fact impacts investment incentives. That can always be mitigated by improving the corporate tax base, but that is a really important thing to think about. And we'll get into that in a little more detail when we think about applications and tax reforms and options there, comparing that to other forms of taxation. And I'll leave it to Daniel to add on to this, but on the international and cross-border side, it's very complicated, remains very complicated post-tax reform. And the future changes really do need to emphasize that simplicity, as well as taking into account the effects on real cross-border investment that are going to be complementary to U.S. investment and to our own economic growth. So getting those rules right really does matter in terms of those details. Erica and Daniel, did you have other bottom line things you want to make sure our audience could take away from this moving forward?
Just to one of your points, Garrett, and I don't think we talked about this. Corporate revenue is only a chunk of our tax revenue, and it to the extent that we want a stable revenue source or revenue sources for the government, corporate income is pretty volatile, and it's important to keep that in mind, especially around like this year, last year, where you're going to have some probably very significant dips in corporate profitability, which will fall into corporate revenue statistics and things like that. I mean, around recessions, corporate income is one of the most volatile sources of revenue.
Very good point. Great. I think we may have time for one quick question. There was a question about the incidence of the corporate tax as it relates to owners of capital and labor. Erica, do you want to review what we tend to find?
Yeah, so there's a large literature on this. In our modeling, we use the assumption that 50% of the burden of a corporate income tax falls on labor and 50% falls on capital. Someone like JCT and CBO, they assume that the split is 25% on labor, 75% on capital. But there's also literature showing that even more than half of the corporate tax burden in some cases can fall on workers. And that really gets back to the mobility of capital and the response to higher taxes on capital income. And that burden is left to fall on workers, often in the form of lower wages. So that's part of the reason why the corporate income tax is so harmful. It falls on capital, which is more mobile, and the burden of that is shared throughout the economy because of the impact on workers. There are, let me see the second half of this question. How would you tax capital income or the returns to capital, I guess, if there was no corporate income tax? We have shareholder level taxes. So that's another component to keep in mind here. The corporate income tax is the first layer of tax on corporate profits. It's at the entity level. And then when those profits are distributed to shareholders in the United States, they face another level of taxes in the form of capital gains and dividends taxes. And so when you're thinking about the burden on the full integrated burden on capital in the United States, you have to think of both the entity level tax and the shareholder level tax, which climbs to a much higher rate than what you would think of when you're just looking at the 21% corporate tax rate.
Thanks, Erica. And we are right at time. So thanks again to everyone for tuning in today to cover corporate tax and international tax policy, and looking forward to seeing you this time next week, where we will be covering various applications to tax policy, especially this year as it relates to infrastructure, climate change, manufacturing, and R&D. So lots of exciting stuff to come here. Looking forward to seeing you all next week, and have a great weekend. Thank you.